Hey, how about now? My sound coming through okay?
Yes.
Alrighty then. Welcome to Charts and Chats with Gordon Scott, CMT. That's me. I'm glad you're here. And if you're here and I'm here, uh, then we got the time change right. And I'm very excited about that. Thanks for finding your way here with the time change and so forth. But I'm going to make it worth your while because we've got some really interesting stuff to work over, and we'll see how it goes. But for now, let me see if I can go ahead and share my screen, and we can talk about what is going on with the markets right now, pre-U.S. Open, and this is I think significant because there's a lot of reasons that people give, and people are imagining that the stock market, the U.S. stock market, could be going bullish this next week, and it might be. It very well might be. We're certainly seeing Bitcoin hit a new high. People are talking about the impact of stimulus checks coming on out there, and I just think that they're missing something. I think that we're looking actually at a downturn in this coming week, but I've been sort of bearish tilted for the past couple of weeks, and I don't I don't know that it's going to happen right away, but I just think that the downward pressure is more likely. All right. So give me a little feedback here if you can. I've got my screen sharing. I'm trying to see what exactly is being shared. And hopefully what you're seeing is a chart of the Aussie yen and the S&P 500, the ES. Is that what we're seeing? Hopefully. Okay. If that's not what we're seeing, then yes. Okay. Thank you. What we're looking at here shows us that from the weekend, we dropped down on the Aussie yen and then jumped back up, but have since sold down a little bit. Now, these are small moves, of course, because they're, over the weekend kinds of stuff. But this is the start of the sessions, the market for this week. And that is the line right there, that 84 and a half, basically, that you got to keep an eye on for the first little bit here on the US Open's Monday session, because if it's below that line, then there's more likely to be selling pressure. If it's above that line, more likely to be buying. And with the case of the futures, we see a similar pattern. We saw this gap up twice. We tried to hit the same peak up there at 34.50 or 39.50 on the ES futures and sold down from them. So I think we're seeing selling pressure just right out of the gate, and that's the big thing, that we are probably not going to be eager buyers in the U.S. market. Now, a lot of people think, okay, stimulus checks, U.S. stimulus checks are coming out this week and starting to have an impact, and we'll see that. The place you'd see that first really is Bitcoin, and the fact that Bitcoin is going up and hitting new highs tells us that that's possible. That is very possibly likely that we are going to see some sort of impact there. In fact, let me open up my cryptocurrency watch list, and okay, so we're backing off Bitcoin a little bit there. Let's get rid of those scales. There we are. And take those things out. There we are. Okay, so Bitcoin hits its high on Friday and has kind of come back since then. But that's sort of it. Watch what Bitcoin ends up doing here as the markets open, because that we'll see whether that continues. See, this isn't stimulus checks actually having an impact. This is the anticipation of the stimulus checks having an impact. But let me hit the 5-minute chart. There it is. Okay. So since the turn of the day, what has happened? Mostly selling, right? A little bit of buying right here, just in anticipation, perhaps, of start of the U.S. Open and time changes and so forth. But to me, this confirms my thinking that we're going to have more selling than buying right now. And so let's see here. Okay. Now, what I'd like to do is take you through something that I've been looking at for a while. I've done some research on this, and maybe just to give you a quick look at why I keep persisting in my thinking that we're going to be a little more bearish than bullish for the weeks to come. And this is a big deal because it's going to have a major impact, I believe, on the markets come May for sure, and maybe leading up till then, but definitely in May. And so between now and May, what I expect is that we'll have some volatility, just up and down, maybe going up a little bit, maybe trending, maybe trending down. But well, I actually don't think we're going to trend down between now and then. I think what happens is we'll drop and then we'll come back up, and then we'll drop and then we'll come back up. And then all of a sudden in as May begins to approach, as end of April and May begins to approach, then we'll start seeing the index get a little heavier, so to speak, and just the price action will start moving down. And then we will see eventually a big drop at some point. That is my expectation. Let me show you why I believe that, okay? Now, if you have ever spent any amount of time commuting in a large city, right, you know that there is a certain amount of anticipation of traffic patterns that you could experience if you get used to it and kind of know what you're doing. So the pattern goes like this. If I have a traffic jam on the way into work, then I can expect heavy traffic on the way home from work, with a few exceptions. Is it the weekend? Is there a sporting event? Is there something that caused people to leave earlier than normal? Whatever, right? But it's not like, see, they say the markets are random and you can't predict them. But the truth is, if you see a bunch of people all coming in at once into the city, then you can expect a bunch of people all going out at once at a later point, right? I mean, there's just, think of commuters as potential energy. If there's a bunch of commuters that all want to go into work at the same time, then they're going to create this condition. And if they've all moved here, then the potential energy is over here, and they're all going to do the reverse. So here's what I noticed. If going back years ago, I did this research, and in the years since 2012, when I published this, it's just gotten more and more confirmed. But what I've noticed is that if people crowd into the markets, there's a certain class of people, not everybody, of course, a certain class of people that behave a certain way in U.S. markets. When they go in all at the same time, this class will come out at similar times, or they'll have the tendency to want to, and that will create the selling pressure. And so here's how it goes. In the United States, there is a tax condition called long-term capital gains tax. And it is less, it's smaller. It's a smaller rate than ordinary income taxes. If you go put money in the market and you you buy something, it goes higher in a few days and you sell it, and you notch these gains. If you had bought Bitcoin last week, you could be making 10% gains. Same with certain stocks. GameStop, I didn't trade, I wasn't one of the early guys that knew and recognized that, but I did trade the bounce when it came back down. And not at 400, but down about 160. And then I sold on Friday, and that was 30% on my money. And so I was happy with that, but it wasn't millions of shares. I wasn't that confident to try and take GameStop through that. It was just a normal trade for me, 1% risk of my account, and I made 30% gains on it. So that was good. The fun thing about it for me is the fact that I recognize, hey, I can just treat weird stuff just like the normal way I trade, and it still works for me. That's confirmed over and over again. But I would have to pay taxes on that income that I made from GameStop trade at the same rate of whatever I'm taxed with all my other, income. And so whatever tax bracket I fall into, same amount. But if I were to have held GameStop for a year and then sold it, one day more than a year, I would have to pay only about half as much, 10 or 15% long-term capital gains taxes. And depends on, what your bracket is. But usually whatever your bracket is, long-term capital gains is about half. So it's like, hey, I can make an investment profit and taxes are 50% discounted. Why wouldn't I do that? Right? Well, the reason I wouldn't and don't do that is because I don't want to wait a year. And that's not the kind of trader I am. But there is a large contingent of investors in the US markets that do believe that way. I became aware of this years ago when I was talking to some professional money managers and and several professors at business schools. And they all said that same thing. It's like, well, I would never consider selling with less than 366 days. That's the rule. I don't even have an exit rule. It's just an allocation rule. I only limit my exposure. And so I realized, wow, if that's a prevalent thing, and we've got professors out there teaching the professionals, and the professionals go into the workplace and they teach it, and they tell their clients, hey, we got to do this, then maybe that's where I got the idea to start researching this. And in fact, it's a real thing. So I thought, what conditions, if people all have that mindset, what conditions would trigger them to do things at the same time? Well, real easy. If you see the markets go up an unusual amount, a large amount, then that means that an unusual amount of money went into the markets all at the same time. And if a significant portion of those investors and traders who put that money into the market are now saying, okay, I'm going to wait until 366 days at least. If you see that sort of thing going on, then what happens is that they're all going to be tempted to bring that money out at the same time. And that is what creates the 56-week pattern. And the 56-week pattern is a real thing. Here's just how real it is. Okay, if I look at this chart, have a look that in the first 20 days from December 24th, 2018 up till 2019, the markets rose about 14.5%. That's super high. They don't usually go that high. In fact, only 3% of the time on any given day will the market rise more than 7% over, a 20 period or one calendar month period. But if they do, then 56 weeks from that time takes about an extra month for, kind of the critical mass of investors to respond. So if that occurs, if you ever see the S&P 500 go up more than 7%, then 56 weeks later, there will be more selling than average. I actually went back. I mean, I think the long-term capital gains thing only goes back into the 90s, but it doesn't seem to matter. It seems like that this is true even without the tax activity, because the effect goes all the way back to 1927, 28, when the S&P 500 starts. So I looked at all that data, and there is a noticeable decline in average returns 56 weeks after you get this 7% rise. And so look what happened this most recent time. And that is right there. If you start it and you go forward, I got this at 272. It should actually be 269. 1, 2, 3. There we go. And if I move this thing so that's right on the edge, that's the way I count it. Yeah, there's it's amazing how perfect this comes out. So if you start your count, you start the clock on this day right here, the 24th of January, 2019, and then you go forward 56 weeks to the 19th of February in 2020. Of course, this is when the COVID starts off, right? Now, the COVID headlines have been going for about 6 weeks, in earnest. They've been going for about 6 weeks before this time. Why didn't the sell-off happen sooner? Why didn't COVID happen? Well, my theory is that nobody wanted to sell if they didn't have to. And when it became clear, Italy, headlines started happening in Italy. It's like, oh, the spread, we can't contain it to China. I mean, it's no expectation. Then people started to get nervous, but they waited, and many of them waited until their 1 year was up. And once it hit, boom, they were like, okay, now I can sell. And they started selling it, and they sold really fast. They could sell all the way down to here without, on average, because they bought back there. And look what happened. Once all that selling went right down to where it started, that was the place that it turned around and came back up. Now, could I have predicted that from, precisely? No. I mean, I didn't at the time, because I wasn't thinking that we were in this kind of condition. However, I have in the past used this multiple times. And most importantly, what's happening going forward? See, because there's this huge rise right through here. Well, that's what I'm going to be sharing in weeks to come. But for today, I, well, let's see, maybe I could walk you through that. So what's really interesting here is that this 56-week pattern, if I just take this and apply it going forward, okay? So what happened at the bottom of, let me scrunch that down a bit. What happened at the bottom of the US markets in the whole, post-COVID thing? So I go right here and I see how high did it go. I mean, it was this crazy move. It was super, super strong. And if I get 20, there we go, 20 bars, 26% at its peak from, and maybe more depending on where you count. I sort of split the difference between there and there as the bottom, but whatever, it's super high, 26%. So that qualifies. Anything more than 7%, right? It's a lot more than 7%. And then we throw this pattern right on top, just at the end of it. And this is our timer. This is what's coming. There's a whole bunch of people that got in right here, a whole bunch of money that got into the markets. And when is that going to come out? Right there. And what are these days? The 14th of May is the day before that happens. So that's why I'm telling people 14th of May is D-Day. And the period running up to it likely to be to have some difficulty. But what's also interesting is, because COVID was so unusual. Now, it might be that's all just an anomaly. COVID just kind of came and went. And which tells us all of this was a massive overreaction. massive overreaction to a lot of unknown. People just didn't know what was going to happen, and so they sold it off thinking it could be terrible. And then they decided, oh, it's not that bad, and they've been buying back in ever since. And of course, there's stimulus checks and all sorts of other stuff happening. But what I'm noticing here, so while this might not time out the same way, I'm just noticing that there's another 20-day period here, and another one right here, in which there was more than 7%. See this? So if I imagine that each one of these is a collection of investors going in, and there, if I put another one there, it would be another one right there, right? All of this money over a large period of time, once it moves 56 weeks into the future, then you have a larger number of people. It's not guaranteed that they're going to sell. It's that they're tempted to sell. They're thinking, well, I've got really good gains. In this case here, I mean, good grief, what a huge run this has been, right? This is like a 50, 60% return, 75% return up to get up to there, Who doesn't want to take profits when you see a once in a lifetime kind of move like this, right? Who is it going to be tempted at least to take profits? And so the people that bought in here, and the people that bought in here, and the people that bought in here, as their clock hits 56 weeks, they're going to start thinking about selling. And what this means is that starting in May, there's going to be a huge temptation for people to be sellers, and then again in June, and then again in August, and so forth. And so all summer long, you could see the U.S. markets tick lower and lower and lower, and that could be a serious bear market. Now, as I say, it was an anomaly. It was a weird thing. So maybe it won't happen. I think there will be at least a little selling pressure. And what I've noticed with this pattern is that the selling pressure lasts about 4 to 8 weeks. The longer and deeper it lasts, the more of a bear market it implies, or I should say a downward market it implies. We haven't had a big downward market for a long time. 2008 was the last big US market crash. Everything else has just been heavy volatility. With all of the stimulus spending, both by the Fed and by the government itself, the US government, the Treasury, with all that going on right now, there are a lot of macroeconomists, macroeconomists who are saying, oh, no, the markets can't go down. Way too buoyant, way too much money out there. But at the same time, we're also looking at other things like the number of houses in foreclosure. It's not that many right now, actually. It's only, 5% people that can't pay their mortgages or their rents or something. And that number is moving lower and lower. And they've extended the whole forbearance program for another 6 months. So it's very possible that, we won't see all of the dire things that have brought this out. But we never know what's going to happen. We don't know if wave 2, I heard just this weekend that the Amalfi Coast was possibly going back down into lockdown in Italy, possibly going back into lockdown because of a new wave of COVID that's happening there. What if all of a sudden COVID morphs and becomes worse? And I think there's some real reasons why that won't happen, but we don't know. If all of a sudden bad headlines showed up in late April and early May, and people started getting nervous and scared about whatever's going on out there, then when this timer hits, they're gonna give in to that temptation to sell. See, that's the thing. It's like they don't necessarily act; they're tempted to act. If they act, then stuff happens. If they don't act, no big deal. Let me show you 2 other instances where they did act. Okay. Let's see. I'm looking to see if Dave settles here in the room. I'm not seeing Dave. If for some reason, Dave, you're here and you're just not showing up, be sure and text me or let me know you're here. Okay, so going back to 2009 and 2010. So look at this. This is actually the first time I noticed this pattern in a very distinct way. At the lows of March in 2009, from that low to the next 20 days, there was this, huge move, 14% upward gain in a month. And then for the following year, 65%. The 56-week timer, when did it hit? It hit right around in here. And then the flash crash. See, that's a lot of people wanted to explain the flash crash with, oh, it's computers, it's brokers bringing in a whole bunch of S&P 500 futures. Yeah, they brought a bunch of S&P 500 futures to the floor, but why? Why did they do that? Because their clients told them, sell me out. Why did their clients tell them to sell me out? Because they were sitting on 65% gains. And right around this time in 2010, that's when the first bit about Greece defaulting and some of the European economies potentially defaulting was really starting to heat up. I mean, it had been going for a little while. It was in the headlines. You saw these, sort of protesters in Athens and looting and stuff going on. And but people didn't sell off immediately. Instead, once that timer clicked over, that's when the sell-off began. Now, how long did it last? This one lasted about, well, okay, if you start on this day of the flash crash, then in 4 weeks it had found support, went down a little bit lower, but came right back up. When this thing here didn't go down significantly, it came back up, and then right here, this was my signal right here, be a buyer. I could tell, hey, we're coming down. We hit this lower high, but we didn't hit a lower low. So this is it from this point. And it turned out that although we did make one more low, that was a great time to be a buyer. And now fast forward another 56 weeks, what do you get? You got that big mess. And then same sort of situation here. We came low, we went up, and 56 weeks forward from there, where did that happen? Right there. Okay. So what was this all about? This was the election between Barack Obama and Mitt Romney. And I was telling people, it doesn't matter who wins that election. Markets are going to go down afterwards. The question is, how long will they go down? And so this was, slowly grinding in. And then all of a sudden, the election happens right here. And sure enough, it goes down. All of this was selling pressure from this previous 56-week clock. And the question is, how long would it last? Well, it hardly lasted any time at all, just 2 weeks after the election, which is about 4 weeks. And so I knew at that point, look, it's only 4 weeks. If that selling pressure gets done in 4 weeks, then be a buyer. If it lasts 8 weeks or longer, it's going to go down. It's going to go down worse. That's what I've seen. So anyway, those are a couple examples. So where are we now? Well, as I mentioned, we are waiting for May 14th to show up. And what we're concerned about is the fact that the weakness has already gotten started. See, we're increasing in volatility. These days are kind of getting bigger and bigger red days, right? And we're all the way right back up to highs. So you could say, well, no worries. We're going to keep going. Yeah, maybe. Here's the thing I'm watching at a more granular look. This is the NASDAQ 100. And you see here, this is a classic head and shoulders pattern. And I studied patterns a lot, but I'm not actually a big believer in the predictability of patterns. And why isn't that? Because it's white, so it's probably drawing and I'm not seeing it. Yeah, there we go. Okay. So I'm not a big believer in the predictability of patterns, but I am a big believer in the setup. in the idea that this is going to help you recognize how to risk, how to judge your risk. And so here's what happens. The thing about the head and shoulders pattern, yeah, I know it's got a funny name, but what it really is just a trend change. Higher highs, higher lows. See? So you're getting high, low, and a new high. For the first part of it, this is the first shoulder and this is the head. But it's still the same pattern. And then what happens is all of a sudden something changes and you break that upper trend line, just as this did. And then you get a lower high and a lower low. See, so that's the trend change. There's nothing special about it. Give it a funky name, whatever. It's just the trend changing. Notice what's happened with this trend change, though. See that volume? As we started coming down, we really got a lot of selling, a lot more selling, and it was sort of picking up and accelerating as it went. So that's the classic head and shoulders pattern, that you get this trend change and you get an increasing volume as the trend change plays out. And what we didn't do is stop right there. Broke through, usually hit resistance somewhere right around there and come down. We kind of came up all the way through, and now we might even find support on what was the head and shoulders support line before, should have been resistance. So if that's the case, then we'll go back up. In fact, if a head and shoulders pattern fails, there's a high percentage of probability, like 70%, which is really high in pattern world, that it will lead to a new high. The trend will reestablish itself. I mean, look over the S&P. That's kind of what's happening, right? Well, then why isn't the Nasdaq back up to a new high? Nasdaq's got a long ways away for a new high. The Nasdaq tends to lead the S&P 500 a little bit. So I'm going to keep a close eye on this. If this actually comes up and starts making a higher high than this, green flag. We're all good to go. The market's going to keep rising again. If in fact it doesn't, if within the next day or two we get the selling pressure and we come back down below this line, then good chance that the markets tend to push lower and languish. And we're not there just yet. The markets don't want to just throw money away and close out their positions. The big buying that began the COVID or post-pandemic bottom still is, people are waiting to sell. Now, who are these people, right? They're not people like you and I. They're not people that trade. There are sufficient traders that have large accounts that move in and out and so forth. There are proprietary traders that they make up one influence, but there is a large collection of mutual fund investors, of ETF investors, the people that kind of buy and hold mentality, and they say buy and hold and they think forever, but the way they actually behave is that they sell in 12 or 13 months. Maybe not all, but at least some, right? And we're talking about high net worth individuals, billionaires, individual billionaires, or even multimillionaires, 100 millionaires or whatever, who have a significant amount of money in the stock market. If you have, thousands of people like you and I, or millions of people like you and I, that's what it's going to take. A whole bunch of those people all thinking the same way. High net worth individuals, you can have 100 of these, 100 millionaire plus type individuals who have significant money in the market that all decide to do, or, not even all of them, just 50 or 60 of them or 70 of them all think the same way. And if they start doing stuff, that's enough, right? Now, you don't have to think about individuals either. Think about hedge funds. There are hundreds of hedge funds out there that have over $1 billion in assets under management. Now, all of these funds and these high net worth individuals and these family offices, the family offices is basically a hedge fund that manages one trust of high net worth individual or family, right? So you have all of these people that have this collection of money, and they say, okay, it's been a year. We've had a great year. Let's take some profit. Let's lock that in. And these guys are just trimming their nails. But the fact that a bunch of them all do it at the same time, that just means that there's a lot of selling pressure that could come just because they want to take a little bit of profit. So if all of a sudden the high net worth crowd and the traders who are watching stuff like this Head and Shoulders, so forth, they all start doing the same thing, yeah, that's what happens. Big market downward influence. And that is the condition that is potentially going to take hold of the markets in May of this year. And as I say, COVID was an anomaly. Maybe this will be anomalous, and it just won't happen. But there was so much money that came into the markets at that time that it's going to be hard for people to withstand the temptation to be selling out anywhere through the summer months. So let's get an idea then. What are we looking for if we're talking about this possibility that that's going to be coming? Well, should we be trying to buy stocks right now? Okay, so first off, maybe it won't happen. Maybe the markets will just keep going up. Maybe everybody's right with all the stimulus talk. All the stimulus money is going to come in, and it's really going to push things higher. If that were true, we wouldn't want to miss out on the opportunity. Where would those opportunities be? All right, I'm going to bring up this chart here, or load this layout, which I have that helps me look at sector micro or sector rotation. Which sectors within the U.S. markets are really moving most dramatically right now? And as soon as that chart fully loads, yeah, it's still working. So if you look at the ETFs that are, yeah, okay, there we go. Now we're loaded. So we have right now, since March began, we've got the euro trending lower. See that? We've got gold prices continuing to trend lower, and we've got the US dollar now starting to trend higher. All of this is telling us that it's putting extra pressure on stock prices. How do I figure that? Well, if the dollar gets more expensive, then commodities but mathematically, commodities that are priced in dollars, the euro USD pair is literally the euro priced in US dollars, right? Gold doesn't have something on the other side of it, but it is priced in US dollars. So it's gold versus the dollar. And this is the dollar index itself. So dollars getting more valuable, more expensive, more desirable. These commodities are pushing down. Stocks are the same thing. That is, they are priced in dollars. Now the comparison is, the availability of dollars and blah, blah, blah. But the bottom line is, where's that general pressure? And the answer here is that the general pressure is to the downside. Okay. So that's the context. Now we go looking at the sectors themselves over the past 3 months. That's the time period I like to look at, what sectors have been performing best over the past 3 months. Now, there are only two that I really have to pay close attention to for bullish, bearish, bigger impact. And that's this one, the utilities sector, which in this case is that purple line, and the consumer staples, which is that blue line. They are both at the bottom, right? What's been really driving the bus is energy and the financials. Now, technology here in the middle, it's hardly going anywhere, right? But notice that little surge on technology, the NASDAQ coming back. Now, there's another sector in here I'm going to add to it. Let's do compare, and we'll do XLY. This is consumer discretionary. A lot of people feel like consumer discretionary is where all the stimulus money is going to go. And let's see, where I'm looking for what, for where XL, oh, there, yeah, XLY came out as light green. Oh, really helpful chart, dudes. Okay. Let's open this up and give it a different color. We'll call it We'll give it a bright orange color and we'll make it really fat so we don't miss it. All right, see that? See how that has come down, but it is popping up even faster than XLK. So we've still got finance moving up. We've still got energy moving up strong, but consumer discretionary, if I were to come in here and just say, okay, just over the past week, right, what's happening? You can see consumer discretionary is really high. Utilities is making a bit of a surge, and that's a worry, but that fits exactly with what I'm talking about here. And it is moving up so strongly that we got to keep an eye on utilities. And consumer staples, well, consumer staples isn't outstripping the other stuff. But when we see utilities and staples move up, then we realize that's people that are afraid and they're trying to move their money to safety. But right now, this is doing even better than they are. XLY. XLY is the consumer discretionary. And so what are the companies in the consumer discretionary space that all that money's running into? Okay, it's this stuff. Home Depot, it's Disney and Comcast and Amazon. These are things where people just go spending money to be buying stuff. Well, because of what they want. Amazon's not looking very good. Amazon has really had sort of downward, the sideways pressure and then downward as of late. So not exactly sure. But I mean, Amazon's huge, right? It's buying everything. So hard to say. They've got some other internal pressures as well. But Home Depot, on the other hand, people thought Home Depot's revenues were higher, but their profits were lower, and so that meant their margins were bad, and that's what sent this when they did earnings. That's what sent these prices going down so rapidly. But notice all of that has been wiped out. All of that has been recovered, I should say, as during this period of time. And what has happened in between? What's happened is that the stimulus bill got voted on positively, it passed and got signed, and now they're starting to act on it. And so people are thinking, discretionary, right? And what do you do at Home Depot? Well, it's spring. Not quite spring, almost there, but the spring season's going to come, and that means people are going to start going to home improvement stores to do landscaping and all that kind of stuff. So the other company that is just like Home Depot is Lowe's. So HD and LOW are both making these big upward surges. So if the markets are not going to go down. Why isn't it they're not going to go down? Because of the stimulus money, right? Where is the stimulus money going to go? It's going to go to the discretionary sector. So if you wanted to play the upside, Home Depot, Lowe's, and then we show you Amazon would be a good one too, but it's not responding. So it's like, hold off, don't do anything yet. Disney. So the biggest part of Disney, what people, when they think Disney, they think movies and theme parks, and theme parks aren't open. That's not going to, why is Disney so high? Well, it's high partly because of the anticipation of the theme parks reopening. And it's also the Disney Plus channel is becoming a good competitor for Netflix. And so, those are some reasons. But even bigger than all these other reasons is sports. ESPN, it makes up more of Disney's revenues than the theme parks or anything else, the movies, anything else that Disney does. The biggest chunk of profits come from advertising revenues on sporting events because Disney owns the ESPN network. And so what do we got going on right now that would be sports? Well, college basketball in the US, followed by pro basketball. And it's not so much that those events are big, it's that those events were nothing this time last year. They canceled the tournaments and now they're back. And so people are interested again. And where they were getting zero ad revenue, now they're getting some and growing revenues out of that. So that's a lot of what's driving Disney. And you notice it's not as strong looking as Home Depot and Lowe's because the timing is not all that strong. But as those events get more popular, as people watch, as people eventually begin to attend, then we might even see more stuff. Greg's asking, have the ratings returned or are they still weak? They're still weak, but they're stronger than they were. Say it's relative. Yeah, I mean they're weak by comparison to where they've been historically, but they're stronger than where they have been recently. So the other thing too is that people are really doing the streaming thing. So that even though COVID restrictions are kind of lightening up and stuff, people are kind of into streaming, and so I don't think that's going away. Netflix is another one that it hasn't taken off yet, but it might. So keep an eye on that. But for right now, Home Depot and Lowe's. So how would you do a Home Depot trade if you were going to try and do it right now? Well, probably the most conservative way would be that if you buy it anywhere in here, you set your stop loss down there and you try to target up here. So let me just draw on the chart what that looks like. Yeah, there we go, long position. All right. So we're talking about this as the stop and that as the target. Okay, so that gives it lots of room to play around. And then if you get up here, you take it, right? So it's a 9% drop versus a 4 or 5% rise. This is risking 2 to make 1. That means statistically, you're going to have a 66% chance of making that kind of profit. Now, if it goes, if it gets up here to 5% and you don't want to take the profit, great. Move your stop loss to your entry and then just trail it up. Let it keep running. If you're of the opinion, or if you see the markets start just going, wow, up and up and up, more and more stimulus checks coming at us, and we just keep, good, ride the trend. There's some real possible scenarios where Home Depot goes on a 6-month upward trend from here. That Home Depot has its own 56-week pattern, and based on where that 56-week pattern shows, there's one version of that, according to my preliminary research on individual stocks with this pattern, that Home Depot might have a very bullish influence for the next 6 months. Well, I mean, you can't both, you can't bullish. We couldn't go bullish on Home Depot for 6 months and bearish on the market for 6 months. So something's got to give. But what could happen is that we go bearish and Home Depot doesn't go down as much as everything else. Or we could go bullish and Home Depot outperforms the market, does better than all the others. And either way, those scenarios would those patterns would hold true within the scenarios. So I'm very bullish on Home Depot and Lowe's, not necessarily because I think they're going to go up, but because they're probably going to outperform the markets over the next 3 to 6 months. And so this is a short-term setup. This is, I don't like to play stuff for 6 months. Over the next week to 2 weeks, 3 weeks, I think this is a real possibility for Home Depot. And if you were to play options, then of course there's all kinds of things you do. My favorite thing to do is a calendar spread on Home Depot. I'm not sure, I'm sorry, on a stock like this, a stock where I'm generally bullish, but it's had a big run, so I know it might, kind of fluctuate and stuff. Great. I'm going to buy a calendar spread. That is a long, an option that won't expire for about 3 months or so. And then I'm going to sell weekly options against it, like I'm doing a mini covered call every week, just boom, 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 trying to collect those. So I started that on Home Depot back here, and did well enough to capture some, but then lost something through here and said, okay, I'm going to wait and reestablish it. Well, here we are. Now it's time for me to reestablish, and so. It's a nice trade, but it's a little complicated for here. Yeah. Okay. So thanks about this one. How about the Caterpillar? Right. Yeah. Caterpillar is really strong, breaking new highs. What's that all about? So this isn't the discretionary trade as much as it is basic materials. And it's interesting to me because Caterpillar's breaking into this new area. I think what's happening here is construction. So interest rates are making this big pop. Interest rates have really started moving higher, and that means the mortgage interest rates for residential homes are going to get I mean they're historic lows, right? But they're going to start coming up because of this. And so even if they come up a little bit in the US, those mortgage rates are still going to mean houses are very affordable. But what it is going to do is say people, it is going to help people who feel like, well, I've been wanting to buy a house, but I'm not quite sure. Um, and they're going to rush to go ahead and buy now because interest rates are coming up. It's like, oh, I got to hurry and get low interest. And so there'll be this initial surge before the housing demand drops off. We also have housing inventory really low, like a 5-year low right now. And it's even more than a 5-year, but it is at least a 5-year low. So there's a low supply and a high demand and a sort of panic demand, which is going to hit the markets. And that means people are going to rush out and try and start buying a house if they were in the market to buy a house. Okay. Just like people behave that way with interest rates and houses, they do that same thing on a commercial scale with interest rates and construction projects. And the evidence we have for that is Caterpillar. So you got big companies that are like, well, let's do a development project. Let's build a whole neighborhood of homes. Let's build a store in this neighborhood. Let's upgrade these facilities. Let's upgrade the schools, whatever. While interest rates are really low and they're kind of making a turn, then people realize, hey, we got to lock this in now. And that's a time when you just see big construction booms take over. And just on the hill up above, or the mountain just up above the town where I live, there's a like 12,000 square foot house being built and a commercial crane building out there helping to build this residential property. I've never seen that before. I live in a bedroom community outside of Salt Lake City, Utah, and there's some really nice homes up in the hills, in the foothills where we live, and somebody's building this giant home on top of a hill that I can see from where I live, and they they brought in a commercial crane to move stuff around for that. It's like, why would they be spending so much? Well, I mean, it's this multi-million-dollar construction project, and it's not just a house, but cranes all over the place in Salt Lake City, and it's not just Salt Lake City; it's all over the U.S. A lot of construction going on, so that's the same dynamic that's driving Caterpillar. The idea that Caterpillar is breaking out, making new highs, says people think this is going to continue. This is not just like, oh yeah, we were excited about earnings. Earnings are way back here, right? No, this is the anticipation of new construction projects yet to come. And so on the Home Depot, it's like, residential retail side. On Caterpillar, it's the commercial and that sort of construction side, but they're both the same trade, and they're both connected to the same things. Yeah, the interest rate bit that also hits Home Depot too, because it just drives more and more people to want to buy houses, which means they got to buy everything you buy at Home Depot after they get in the house. So yeah, Caterpillar looks great, and same thing. Calendar spread on Caterpillar, or you could just set up the trade to where you do this same kind of setup we were talking about with Caterpillar. Where would you put the stop? At a minimum, you'd put it here. If you're really aggressive, you can put it right there because that's a breakout. If you're the kind of person who likes to risk a small amount and get a big payout, then this is the type of trade you would set up. Now that trade has only about a 33% chance of being successful. But if it is successful, it pays out, more than 2 to 1 because it keeps trending. And so you got to figure out how you're going to play the game. Am I going to play the game where I'm going to make a little hit, make a little hit, or try to take a swing at something, make a small bet, and I know I'm going to lose most of them, but the big ones are going to pay off. Am I going to play the game that way? Or am I going to try to win most of the time and be this consistent profit taker? If that's the second way, then you would do something like this. You'd set the stop there and you'd set the target. Got to get this thing out of the way. You'd set the target to be about half that distance. And if you like the idea of holding on to a trend, great. Then when it gets to there, just move the stop up and let it run, and you get potentially even more. But those are the 2 different ways you could tend to play it. Right now, the U.S. heavy machinery stock are bullish like Deere as well. Yeah, same dynamic happening, right? Yeah, that big movement. It's because of the interest rate thing that we're talking about. All right. Well, to wind it up today, let's revisit where we're looking at now. What you see here is the Aussie yen has not regained that opening line. The S&P 500 has, at least they're above the previous close, but they're not above the previous open. So I think that I'm just going to expect that the U.S. market is in for a little bit of selling. Now, right out of the gate, they may not sell. It might be that right out of the gate, there's buyers because, people are thinking stimulus checks. But right here, very, very clear that, let me get this line in there. Very, very clear that that's the resistance level right there on S&P, S&P 500 futures. Come on, stay, there it is. Okay, that red line. So if it does go up, then we're looking at 39.47. Sorry, I look around one monitor, see the end of the other. 39.47 as a potential resistance point. And that could be a full, you could get a nice good buying day today and then hit resistance tomorrow based on that. But that's what we're going to keep an eye out for, is where's the selling pressure going to come in? If it doesn't, if we just go running right up and we make a new high, fine, we're all good buyers for the week. But my anticipation, because I'm looking at the euro, I'm looking at the price of gold, I'm looking at the movement of the dollar, and most of all, I'm looking at the Aussie yen. And what I see here is just this sort of downward trend, and I expect that that'll carry over. The attitude of the global investor is, right? If that's the attitude, then investors are going to be looking for excuses to sell. And so here in a few seconds, the market will open and we'll just see how it responds and see what dynamics take hold. While we're doing that, I'm going to bring up Home Depot up above. As you can see, Home Depot gapped up, came down, and is still heading higher. So, and here we go. Let's see what happens right out of the gate. And we came down. See, that line is important, right? I mean, people remember this is where we closed on Friday. So if they think, hey, where we closed on Friday is a good place to be a buyer, then as we touch that line, buyers should, have their limit order set right there. It's like, I want to buy that. I want to buy that piece, right? And just that initial up and down kind of holding, that looks like what they're doing. So the question is, will people start chasing the bid? I mean, not chasing the bid, chasing the offer, stepping off the bid, as Jay Woods used to describe it. They step off the bid and come up higher and higher. And if they do that, then, well, that means there are buyers. If in fact they sell down here in this first 5 minutes to below that line, then there might be buyers, but not enough. and the selling pressure that I was talking about would be taking effect already. Really interesting. We're back and forth just in this first minute. That alone tells me that it's not high conviction. See Home Depot, there's high conviction up there. So remember that part that I was talking about. Home Depot is going to outperform the markets. We're seeing it already, right? But Home Depot is one of the stocks in the index, and so you get a lot of buying and selling, a lot of back and forth. This, if this is selling down, but this is going higher, it's pulling. Okay, looks like the markets have made their minds up. People are stepping off the bid. They're deciding to buy and pushing the markets higher. And so keep an eye out, because although we are going higher, clearly they're nervous, and I'm expecting there to be this sort of selling influence come in somewhere today. The question will be, will they sell it enough to make to breach the overnight lows of the S&P 500? If they do, then we'll see that downward trend in the NASDAQ and the head and shoulders. We'll see that continue. But if they don't sell it and break the low here, then we can probably expect to see more buying for the week to come. Just as I said that they were stepping off the bid, now all of a sudden they're turning right back around. 2 minutes into that 5-minute candle. And are the buyers going to get overwhelmed? This is really interesting. It's staying in that tight bracket. Okay, now they got overwhelmed. There it goes. There's the selling pressure I was looking for. All right. Hope that's useful for you, everybody. It's a few trade ideas, and we're going to come back and do this again next week. Next week, my guest is a former trading student of mine. She had an interior decorating business, and she doesn't bother with that anymore because she's so good at trading. That's just what she does. I can't wait to introduce you to her and hear a little bit and get you to hear a little bit about how she does her trading. She's even shorter term than I am. She is an intraday trader, and she's very good at it. She's first time she's ever been on a show as a guest, super shy. So, don't scare her, but she's a delightful, pleasant personality, and you're going to love listening to her. So we'll look forward to that next week. Until then, everyone, take care and trade well.